Hello, I'm Gavin Rochussen, Chief Executive of Polar Capital. Alongside our Group Finance Director, Samir Ayub, we will present an overview of our interim results to 30 September. The past 6 months have been a challenging period for equity markets, driven by a volatile macro environment. Like many of our peers, Polar Capital has not been immune from these challenges, which have resulted in a period of net outflows. But equally, we have seen some bright spots, which we will highlight. Performance has been positive, with 73% of our AUM in the top 2 quartiles of the Lipper peer group over 1 year, and 93% since inception. We have seen net inflows into a number of our strategies, with our emerging markets and Asia teams seeing over £240 million in this period. We also saw net inflows into our smart energy, Japan and European ex-UK income funds. On a gross basis, all of our strategies saw gross inflows, signalling ongoing demand. Our strong balance sheet provides support for the dividend, allowing us to declare a 14p interim dividend, in line with last year. It was also pleasing to see that Polar Capital won the European Asset Management Firm of the Year in the 20 to 100 billion category at the Funds Europe Awards 2023. Looking at performance in more detail, the chart here shows all funds bar one are in the first or second quartile of the Lipper peer group since inception, and the vast majority have outperformed their benchmark on an annualised basis since launch. For our UK Value Opportunities Fund, which is currently third quartile since inception, a headwind has been the fund's exposure to small and mid-cap stocks, which have underperformed their larger peers. Given the valuation gap that exists, we are optimistic that performance will improve. Looking at other time periods, performance remains consistent, with 84% of AUM in the top 2 quartiles over 5 years. Strong performance in many Polar Capital strategies, and particularly technology during 2020, has created a high starting point for the 3-year performance numbers, which is why the percentage of AUM outperforming over 3 years is lower than over 5 years and since inception. As you can see, there has been a marked improvement over 1 year. Despite a challenging environment for equities, our assets under management ended the reporting period at 19.1 billion, representing a modest decrease from the previous 6 months. Our AUM has grown at a compound annual rate of 7.5% over the time period shown. Like many of our peers, net flows have been impacted by a risk-off environment where equities have been sold down. The Melchior European Opportunities Fund was negatively impacted by asset allocation moves away from UK and European equities, and from small and mid-cap stocks, which the fund has exposure to. The Convertible Bond Fund also suffered outflows, as income-driven investors were able to earn higher yields on risk-free gilts and money market funds following the rise in interest rates. The Global Insurance Fund experienced redemptions by a few investors who decided to take profits, following the 2022's significant outperformance. However, we are seeing renewed interest in the fund, given its defensive characteristics. Pleasingly, we saw net inflows into our emerging market stars, European ex-UK income funds, smart energy and Japan value funds. And encouragingly, the rate of net outflows from the Global Technology Fund continued to slow, with performance of technology stocks this year surprising on the upside. All of our strategies saw gross subscriptions in the period, signalling continued demand. October saw heightened market volatility and bearish sentiment take hold. Polar Capital's net outflows in the month amounted to £390 million. Though this increased selling pressure was largely due to 2 clients who accounted for 70% of the outflow, as opposed to a wider general trend. Despite a challenging month for flows in October, AUM, as at the 10th of November, stood at 18.9 billion.
Underlying the financial results is a 3% decrease in our average AUM to 19.4 billion when compared to last year's first half. This in turn translated into net management fee revenues for the period of 76.4 million. Our net management fee yield over the period measured 79 basis points, which is in line with our longer-term guidance on fee margins, reducing by at least 1 to 2 basis points each year. Looking at the key components of our profitability, the lower average AUM base meant core operating profits declined to 22.5 million, resulting in a core profit margin of 29%. Most of our performance fees crystallise in the second half of each financial year, so the absence of such profits at this stage is to be expected. Other income represents the profits and losses on our seed portfolio net of hedging costs and interest income on bank balances. During the period, interest income earned on cash balances has increased and offset the relatively flat mark-to-market and realised P&L on seed and hedging. Tying everything together, and this translated into an adjusted diluted total EPS of 17.2p, which is a 9% decrease. Given the strength of our balance sheet and our confidence in the business, we have announced a maintained first interim dividend of 14p, which is an 81% payout of adjusted core earnings. Total operating costs for the period were 55 million, which is a 1% decrease on the comparative period. As the chart on the right illustrates, this decrease is driven mainly by lower variable staff costs, with total staff compensation costs reducing 6% period on period. Offsetting this reduction is a period-on-period increase in other operating costs. This results mainly from taking on additional office space in the existing building and extending our main lease out to 2028, as well as tactically increasing spend on marketing and client interactions with a view to defending assets and to position the business for when investor sentiment changes. Exceptional costs are items that are either non-recurring or non-cash and therefore excluded in determining adjusted diluted EPS. Amortization on intangible assets was the only such item of cost in the current period. The total cash and seed portfolio holdings of 107 million at the end of the interim period demonstrate the strength of our balance sheet. Our seeding program supported 8 funds at the end of the interim period, with the seed money in Smart Energy being redeemed as the fund went through 100 million just after the previous year end. To preserve group capital, seed investments are hedged for market and currency exposures. The capital position of the group remains strong, with an overall surplus capital position of 55.9 million. The bar chart on the left shows how the allocation of capital across seed investments, regulatory capital, and general working capital remains broadly consistent. And finally, the framework applied for the use of capital remains unchanged, as we look to balance returns to shareholders with strengthening and growing the business.
As an investment-led specialist boutique, the quality of our product range remains central to our efforts to grow the business. We've taken a disciplined approach to product management and remain focused on developing our range, with conversations progressing on new strategies. Pleasingly, a number of our funds have received rating upgrades recently, with our Emerging Market Stars, Smart Energy and European ex-UK Income funds all awarded ratings by Morningstar's team of analysts. Earlier this year, the European ex-UK Income Fund was added to the Hargreaves Lansdowne Wealth shortlist. We have seen renewed interest in a number of our other funds, including Artificial Intelligence Fund, given the well-documented technological breakthrough seen earlier this year, and the Global Insurance Fund, whose defensive qualities has resulted in an increased client interest. The fund recently passed its 25th anniversary, having delivered nearly 10% per annum on an annualized basis. We remain confident that with our diverse range of differentiated, active specialist fund strategies, we are well positioned to perform for our clients and shareholders over the long term. In volatile markets, client servicing and transparency is key to retaining assets. Our global distribution team remain busy, and this coming quarter will see our busiest period for direct client interaction, with high demand from investment professionals to hear from our fund managers. As we have discussed previously, international expansion and establishing local support centres has been part of our strategy to grow the business. Our US business continues to gain traction, with US domiciled fund vehicles surpassing £125 million, and we've recently opened offices in Singapore and Stockholm to support existing clients in the region and to reach new investors. As Samir mentioned earlier, marketing is an area we have tactically invested in, and we are seeing the rewards of this through increased client engagement. For example, we have participated in a number of events globally, reaching a number of new potential investors. Our digital promotional activity has been well received, with a number of clients actively engaging with our content. We've also seen an uptick in our brand recognition scores over the past few years. In summary, our highly active specialist investment range stands us in good stead to grow the business. Performance remains strong against our LIPA peers, and we've seen gross inflows across all of our strategies showing continued demand. Clearly, sentiment towards equities remains a challenge, but our sales and marketing team remain busy. We have seen strong client engagement, and we have £17 billion of remaining capacity in strategies that have seen net inflows in the period. We continue to search for differentiated investment teams with complementary strategies, whilst considering how we can further leverage our existing talent. Meanwhile, advances in AI have extended the growth cycle in technology, which Polar Capital, with our large technology franchise, stands to benefit from. Our confidence in the business and strong balance sheet enables us to maintain our interim dividend. Markets may remain uncertain in the near term, but in our view, Polar Capital is well positioned with its diverse range of specialist investment strategies. I do hope you found this interesting, and I thank you for taking the time to watch.